In this video, we'll talk about what is inflation, why is inflation so important to know about it, cause of inflation, what does inflation convey to the common people or to the investors. What is inflation? Inflation is an economic term that refers to an environment of generally rising prices of goods and services within a particular economy. As general prices rise, the purchasing power of currency decreases. The measure of inflation over time is referred to as the rate of inflation or the inflation rate. Commonly, people may refer to inflation as the rising cost of living. Inflation measures how much more expensive a set of goods and services has become over a certain period. Why is inflation so important to know about it? Inflation is the decline of purchasing power of a given currency over time. If the money supply grows too big relative to the size of an economy, the unit value of the currency diminishes. That is, its purchasing power falls and prices rise. This relationship between the money supply and the size of the economy is called the quantity theory of money and one of the oldest hypotheses in economics. Causes of inflation. Rising commodity prices often cause inflation. When commodities rise in price, the cost of basic goods and services generally increase. Higher oil prices especially can have an inflationary impact. Higher oil prices mean that petrol prices will rise, which pushes up the prices of all goods and services that are transported by truck or ship. Jet fuel prices go up, rising the prices of airline tickets and air transport. Heating oil prices also rise, hurting consumers and businesses. By causing price increases throughout an economy, rising oil prices take money out of the pockets of consumers and businesses. Economists therefore view oil price hikes as a tax that can depress an already weak economy. In addition to oil price hikes, exchange rate movement can cause inflation. As a country's currency depreciates, it becomes more expensive to buy imports, which puts upward pressure on prices overall. Over the long term, currencies of countries with higher inflation rates tend to depreciate relative to those with lower inflation. Because inflation erodes the value of investment returns over time, investors may shift their money to markets with lower inflation. Investment returns versus inflation. Inflation poses a threat to investors because it chips away at real savings and investment returns. Most investors aim to increase their long-term purchasing power, but inflation puts this goal at risk because investment returns must first keep up with the rate of inflation in order to increase real purchasing power. For example, an investment that returns 2% before inflation in an environment of 3% inflation will produce a negative return minus 1% when adjusted for inflation. Inflation can be harmful particularly to fixed deposit returns. Many people invest in fixed deposits because they want a stable income stream which comes in the form of interest payments. However, because the rate of interest on most fixed deposits remains the same until maturity, the purchasing power of the interest payments declines as inflation rises. In future videos, we'll talk about what kind of investments will beat the inflation. Thanks for watching this video. Subscribe Indian Economics channel to gain more information of Indian financials and share this video.